All trading videos by OFA are for educational purposes only to illustrate sample use cases of the software functionality. OFA is not a trading system or strategy being marketed on a performance track record of live or hypothetical results. Trading involves substantial risk. Please do not purchase or subscribe to OFA services without carefully reading the complete required disclaimers and terms and conditions located on the OFA website. For this first lesson on trend-based trading, we're going to take a little extra time to really walk through the trade identification process. It's very easy to throw indicators on a chart, put profiles on a chart, and think that every move in the market is a swing. And so I think it's very important that we understand how to break down a chart to find those opportunities and look for the key swings in the market that are actually going to produce profitable results. My suggestion is that in the first lesson, you grab a notebook and you take some notes, and you'll probably want to watch this one a couple of times, as there will be a tremendous amount of information in it that will be relative to the other trade examples that we look at. I may not spend as much time on those examples going through point by point how you would qualify something as being in a trend. So grab a notebook, take some notes, and let's take a look going back to the early part of the day, where we can see, to most people, it's going to look like there is a downtrend going on. Well, we have to take into consideration that when we begin looking at the chart, we have to make those decisions right then, right? We don't have the luxury of waiting until the day is over and going back and saying, oh, look at that, it was a trend. We have to be able to break it down in actionable steps. And in order to do that, we have to start thinking logically about what's on the chart. So while many people would assume that this is a downtrend, I would tell you that we are stuck in a range, and I'll start to show why. To begin, let's go back to the 2 a.m. This is London, where we've made a double bottom here. Now imagine that we didn't see any of this, and so we're looking at a chart that looks more like this. At this point in time, it would be very hard to make a case that we are in a downtrend. In fact, it very much looks like a range that's bound by those 2 a.m. lows. It looks to me as though we found support at the London Open, retested it, went up, made a high, traded back down to it, and found some support before eventually breaking down. So if we were to look at the entire day as a downswing, we would have to justify that statement by not having the market crossing the volume-weighted average price. So in order to test that, let's grab a swing profile and start up at the high. You can see that already we have crossed the volume-weighted average price, and we've certainly taken it out by the time we get here. So it's very easy to see that our swing for the day certainly does not begin up at the high. Not only does the swing not begin there, but it would be very hard to claim that we are in a swing until we actually see the market break down. So if we grab a decision point profile and mark off the low here, you can see that all we've really done is come back to test it. We've tested it, we've bounced off of it, and it's not until here at almost 7 o'clock in the morning that any concept of a swing actually begins. We know that we've crossed the VWAP when we traded back up here, so we should be looking for the next forward point, the next highest forward point that we haven't crossed the VWAP to begin analyzing it for a swing. Now that we have the full chart in view again, let's test that as well. Let's grab a swing profile and come off of the high here. Now we're going to choose this high because obviously if we went back here, it would have already traded back up through the volume-weighted average price. So drawing a swing from here, you can see we've already crossed the VWAP here. It just doesn't make sense. So I'm going to drag the profile over and put it right on the high. And you can see that during the breakdown, had we been trading at whatever this is, 6 o'clock in the morning, the breakdown would have been the first place where we would have seen a swing begin to the downside. As we bring this across, you can see that we do challenge the VWAP, but we don't hit it. So back here, where we cross it, you would have had an opportunity to go short with a stop on the other side of the VWAP. Of course, by the time we get to where we're talking about now, we've already crossed the volume-weighted average price in the opposite direction.
Well, if we've crossed the VWAP, perhaps we're in an upswing. Let's begin testing it from this low. I'll bring my profile over, and up until this point, it all looks very nice. However, you can see that we have now crossed the volume-weighted average price. So for where I am at this current moment in time, am I in an upswing? No. Am I in a downswing? No. If I'm not in either one of those, it means that I am in a range. And this, my friends, is very much a range. It may look as though we're in a downswing, but having tested it from both points, we know that we have crossed the volume-weighted average price, and therefore we're in the middle of a range. Ranges will always eventually be broken, so it's up to us to determine where we think the market is trying to go and how good of a job it's doing getting there. At this point so far, all we've done is make a small high and a small low within this range. We have a high here that's been tested, sort of tested here, here, and here. We have a low here that we haven't really tested yet, although I imagine if we put a profile on this to see where all of this volume is concentrated, you can see that we tested it here and we've tested it here again as well. Eventually, we're going to break out to one side or the other. We're either going to break out to the top side, in which case we need to figure out where the market might be trying to go to, or we're going to break to the downside, in which case we need to find out where the market might be trying to go down to. Well, if we go and grab our profile, we can mark off where we think it might go on the low. It's likely that if we were to break down again, we would at least trade down and challenge this for a double bottom. At that point, maybe it breaks down, maybe it holds for a reversal and trades back up. When we're establishing the opportunity for a trend, we need to be thinking about what's in front of us. In this case, if we were to begin to trend down and all we did was trade down to the end, perhaps the opportunity to get into a trend once we broke down through this and recognized it as potentially a downtrend might be so close to this target that it would not justify putting the risk on in the trade. In other words, if I'm looking to make at least 2 to 1 on my risk to reward, and I know that I only have about 10 ticks to gain, that means that I can't possibly take a trade that has larger than a 5-tick initial risk. If I get stopped out, I lose 5 ticks. If I get to my first target, I make 10 ticks. That's a decent risk to reward proposal. But the minute that that goes upside down, it doesn't make any sense. So we have to look at every trade not only as does it qualify as being in a trend, but what can I possibly get out of it? If we look at the bigger scale of the chart, we know that there are a couple of places along the way that we might end up having some trouble. The first would be this obvious breakdown point, right? It's very likely that because we had sellers drive through a level of support, you've all heard the concept support becomes resistance, right? This is a breakdown, and this is the type of trade we'll be looking at when we start learning about breakouts and breakdowns. Okay? The other place that it's very likely that we trade to is all the way across the range. And at this point, we have a 2 a.m. or London session high up here. Let's grab a profile on that. Take a look at where that falls. And you can see that puts us somewhere up around 72.60. Okay? So if the market breaks out to the downside, we have very little potential gain. If the market breaks to the upside, we have a huge potential gain to get back up to the other side of this range. That's the initial steps that we need to take before we ever put on a trade. We have to be able to look at a chart and see where does it make sense that the market might be trying to go, and then we're going to assess how good of a job it's doing getting there. Right now, the market is not doing a good job getting anywhere, and we do not have a trend opportunity yet. But we know that if we break out to one side or the other, that opportunity might be there. To the downside, we probably don't have an opportunity until we clear the low, and I mean the low down here. So we probably will not have another opportunity for a downtrend trade unless we see something similar to what happened here. To the upside, if we can break out of the volume that was concentrated here, that we've banged against 1, 2, 3, and potentially 4 times. If we can break out, we have a very large upside, and that's the trade that we should be looking for. Now, we've done a lot of explaining about how we might find a trade like this, but let's let it come through, and let's be very realistic about when you would actually find the opportunity to put on this trade. I'm going to remove this profile just for the sake of simplifying the chart. What you're looking for as the market starts playing back is either a breakdown through these levels or a breakout through these levels. At that point, and only at that point, can we start determining whether or not we have a trend. Now, we've already established that we don't have a trend off of the low. We know we don't have a trend off of the low because if we put that swing profile on it, we've already crossed the volume-weighted average price. Well, the same is true if we come here. From this low, we have already crossed the volume-weighted average price. So we know that a trend is not beginning from here either. So we have to find the frontmost point that is the lowest or the highest point that we have not had the volume-weighted average price crossed yet. That means that that will be the beginning of any trend for us to profile. The purpose of profiling the way that we do it at OFA by dragging and dropping on the chart is to isolate a very specific event in the market. In this case, we're looking for uptrends and downtrends. So it doesn't do us any good to add in extra data. I want you to think back to all those crazy indicators that you've used over the years. Think back to a moving average or to CCI or an RSI. Think about the parameters that you input into it. You're asking a moving average to look back at the last 21 periods, or maybe the last 7 periods. Tell me what that means. It means nothing, right? It means nothing at all. It is a random data set. You're saying it doesn't matter whether the market moved up or the market moved down or it went sideways or what happened. It makes no difference at all. I want to include that data in my data set because it's simple math for a computer to be able to do. It doesn't make any sense. But when we see an event in the market, something we can very clearly see, particularly with the volume clusters that are on the OFA charts, we can see where transitions begin, where events begin, and how long they run. And by using drag and drop profiles, we can isolate those events specific to that volume. Nothing extra, no extra 7 periods or 21 periods. We're just going to isolate the specific event that's important to us. So we have just crossed 8 o'clock in the morning, Central Time. It's about the time that most traders would sit down and analyze their charts and find themselves in this range. Note that we haven't had any sort of a breakout. We haven't moved anywhere up or down. We're still very much bound by the volume from here and the volume from here. So we've begun approaching the prior high of this small range that we're stuck in. And you can see we begin lifting out slowly. I'm going to zoom in on this just a bit because I want you to recognize the volume that appears to be holding us back in this range. It's not until we actually break out of this that we start to get some sense that there may actually be a breakout coming on. It's very easy to get confused about what constitutes a breakout. Have we actually moved out of it? There's no substitute for experience. When we see that volume is trying to break out of a high and is unable to break out of a high, it's not until we see the market break away from that, which we will see here shortly, where we can truly stand behind the idea that we have moved up and out of a range and have started a new phase of the market or a new event has begun. Now, I just want to give you a point of reference. It's just before the U.S. equity open. It's about 8:22 Central in the morning right now. And so you can imagine that this is right when you've got to start thinking about making decisions, but you also know there's going to be a large influx of volume. We could easily have a false breakout. There are a lot of things that need to go into your analysis that are external from what you're seeing on the chart. And just the idea that as soon as the market opens, we could see a flush and fade back the other direction. So if you're teetering on the edge of a breakout or on a range, you want to be very cautious to the idea that you allow it to truly follow through. And what we're looking for here is just like these green periods, we're looking for a true breakout where we see the market break away from the cluster of volume. This neutral auction right at the top of a prior high is not exactly what would make me excited about the market proving that we have some sort of a breakout. We've now started printing volume up above the prior breakout. While we don't have any real confirmation because we haven't seen any green periods, any buying periods break away, this is a good time for us to start thinking about putting together that profile. Where is it going to be profiled from? Well, we know that we've already crossed the VWAP from down here, and we've already crossed the VWAP from down here. So that means that we need to come into this area somewhere around here. Now, this is one of the biggest problems that new OFA traders have. They get very concerned about which period they should be starting a profile from. So I'd like to take a couple of minutes and walk through it. In this situation, we have 3 consecutive periods where the breakout begins. These two have equal lows. When I'm looking at this, and you'll see many examples of this in this course, when I'm looking at something like this, I'm trying to match up all of the volume that's included in the event. Well, in this case, we have volume at the exact same level as the prior one. The lows are equal. I'm going to include this volume in the profile because to me, I'm looking for anything that could be included in this as buying volume. These are buyers buying up. These are sellers trying to sell back, and then buyers buying through. So I want to include all of this volume. So I'm going to come over and I'm going to grab an active swing profile. I'm going to begin my profile here. Now we can see that we did pull back right against the volume weighted average price. We're about a tick off of it and now potentially lifting up and away from it. I can see the volume weighted average price. I can see the CWAP. I want to go over and I want to grab my profile and get ready to put on a trade. So I go to Algo X. From the selection box, I'm going to select the CWAP. Note that it's color coded exactly as I have the CWAP. So I'm going to grab the CWAP and I'm going to get ready to put on a long. To put on a long, I need to establish an execution algo as well. I know that I'm going to trade off of the volume weighted average price from the CWAP. I'm using the VWAP as my stop. So I'm going to grab my VWAP execution. I'm going to grab my take profit that we've built, and I'm going to grab my management that we've built as well. Wow, we can really see the market starting to break away now. So it makes sense that we might want to get our order out there and get ready in case it comes back to the CWAP. So I'm going to hit the long button, and you'll see that my orders are going out. Now, I want you to keep in mind, this is a take profit order up here. So it's not going to get executed if we get hit until my fill comes in. So you can see down here in the right-hand corner, it says suspended. It's not an order that's live until my initial order gets filled. So I have my fill order at the CWAP. I have my stop 1 tick behind the VWAP ready to go. And now it's just a question of actually getting filled. I want you to note how the orders change automatically. Every time that they update because price, either the CWAP moves or the VWAP moves, it's also going to alter the number of contracts that are going to be executed. So with the current risk profile, there are 13 contracts that are going to be sent given my account balance. Since we began, it started at 10, then it went to 11, now it's 13. So every time that my risk reduces, Algo X is automatically adding contracts to the order. This is why it's so important to have it all automated, because even though you might be fantastic at math, it would be very difficult. Now we have 16 coming in. It would be very difficult to do this on the fly while you're more concerned about whether or not the market's actually going to give you a trade. Right? Am I going to get filled? Well, wait a minute, I need to stop and recalculate my entire entry because everything has moved. This is dynamic trading using the market data to establish where your entry and exit come in. So each time we have an update, my entry order is changing, my entry size is changing, my stop order is changing, and my initial target is changing. The market is beginning to approach my entry order. We've now been filled at the CWAP. Our stop is one tick behind the volume weighted average price. We've been sized into 13 contracts, and our first take profit is just above at the 2-to-1 level. The market is lifted up to our 2-to-1 target, and it's taken our position off there. We now have our next target come out at 3-to-1. Now, while it's very easy in trade examples to get overly focused on the profit of a trade, I want you to keep in mind that this trade is being shown to you in replay. We already know what the outcome is. I am much more interested in you learning about the support that's created from the CWAP in an event swing than anything else. Note that we have held against the CWAP 1, 2, 3, 4, 5 times. We're now pushing against it again. Yes, we have a 3-to-1 target up above, but I'm much more interested in you realizing the support that comes time and time again from the CWAP. You need to understand your ability to take these trades, even if they've already been touched once, even if they've already been touched twice. It's okay to come into the trade late. You're letting the market dictate where your entry and where your stop are. So even if we didn't get it down here, it would make sense to take it up above. Notice how the support is always increasing, moving higher and higher and higher. We're not coming back down to retest the initial level. We're pushing up further and further, finding support at every level. Now let's get a little bit bigger view of the chart, and let's think about some of the places where we knew we would expect to have some sort of support or resistance. Here is our prior support that came in. This is the breakdown, which again, we'll be learning about breakdown trades later. And notice that when we first traded up into it, that is the first place we bounced off of. We then traded up through it, and where did we get filled? Exactly on our prior support, which then became resistance, which then became support, which then matched up perfectly with our CWAP level. We can see the next place that we would expect there to be a resistance level is up at the top here at 72.60. So while we have a 3-to-1 level just a little bit off, it is up at some prior highs, so it might make sense to leave that there and plan to take profit there. But as we get additional targets coming out, it's important that we start thinking about maximizing the trade. If we get 3-to-1 out of a trade on the bulk of the trade, and then we get maybe 4-to-1 out of the trade, we might want to think about where that 4-to-1 should go. There's another place up here with an awful lot of volume. We could probably come in, select some of this, and get a sense for where the bulk of trade was, and we'll see where our 4-to-1 target comes in compared to the bulk of trade up here. We're now lifting for our 8th time off of the CWAP, finding support each time we come back down to it. So we begin lifting into our 3-to-1, now up to our 4-to-1, which I'm going to move out. And you can see that we have an excellent return on a very simple trade, waiting until we see confirmation that a trend has begun. That's when we're going to apply our swing profile. We're going to use the CWAP for an entry with the VWAP as our trailing stop. And as you'll see, this trade ends up moving all the way back up across the range and even gives us another opportunity to get in to the CWAP. So we'll let this play out just a little longer so we can look at that opportunity and see how much further this would have gone. Notice how we're back at the CWAP for a 9th time. After moving up off of it, we've broken away from it, and we're still coming back to it. Even if you had missed all of the multiple opportunities that were found here, you could still take a trade from the CWAP with a 1, 2, 3, 4, 5, 6, 7, 8 tick stop. The CWAP and VWAP hold as support, and the market starts to lift back the other direction. As you can see, we've now reached the other side of the range. There are 3 key takeaways that I want you to think about from this lesson. The first one is how we identified the swing. We walked through the process just as you would do on any day when you sit down at your charts. You have to determine what type of event you're trading in. Am I in a swing? Am I in a range? Am I prepared for a breakout or a breakdown or a double top or a double bottom? We have to establish the fact that we know we're in a range and that it might turn into a swing, and we need to be prepared for that. How do we find that? Well, we look at the prior data and we see that, well, there's no swing from here because it was taken out here. There's no swing from here because it was taken out here. There's no swing from this low because it was taken out with this move down. There's no swing from here because it was taken out by this move down. Right? We have to be able to establish that to understand where we would begin profiling from for an event. The second thing that we want to make note of is how we incorporated the beginning of the profile. Remember, this is the first point where we started the event, the swing higher. We're trying to capture the event as an isolated event. I don't want to add range data into my swing. We can also see how many times we found support from the CWAP never crossing the volume weighted average price. And the third thing that I want you aware of is the fact that we were able to basically isolate where every potential holdup or roadblock in the upswing might take place. From earlier in the day, we recognized that we had support, which had held and then broken down to become resistance. That resistance we bounced off of, came back down. Once we traded through it, became the support that matched up with the CWAP for our entry. Even up above, from another cluster of volume, we were able to identify a point where the market held and turned back down. And of course, all the way across the range, we were able to isolate almost the exact high of the day. Having the capacity to look at the chart and understand where various transitions have come in will be key to you finding qualified targets. It's certainly a good proposition to just make multiples of your initial risk. But if we can improve that by dragging out a target an extra 50 ticks because we see that the likelihood of the market moving up and across is very strong, we want to take advantage of increasing the size of our targets rather than just simply taking flat multiples. As you go through the rest of the lessons in this course, you're going to see more and more examples of different types of transitions. The examples I've used here are what we would call decision points, where we have a transition, in this case from seller to buyer or from buyer to seller. We'll also be looking at different transition points for breakdowns and breakouts. This very easily could have been a breakout trade as well. This could have been a decision point trade up here. Those are the types of things that we're going to be working on, but for now, you're focused on swings, which means we're following the trend, which means we're using the CWAP and the VWAP to execute beautiful trades.